The biggest threat to the U.S. economy isn't AI. It's not China. And it's definitely not the orange guy sitting in the Oval Office. It's something so boring. Most people have never even heard of it. And that's exactly why it's dangerous. Because if you've been wondering why mortgage rates refuse to fall, why stocks randomly panic every few months, and why the Federal Reserve talks about cutting rates, but things still feel tight, the answer doesn't start in Washington. It starts in Tokyo, and more specifically, in one of the most boring assets on earth, Japanese government bonds. Because the country, known for anime and internet culture, has quietly been holding the global financial system together for the past 30 years. And that support? It's starting to crack. To understand why Japan matters so much, we need to go back to the early 1990s. In 1992, Japan's asset bubble burst. Real estate collapsed. Stocks collapsed. Growth disappeared. And Japan entered what's now known as the lost decades, a 30-year period of economic stagnation. No real growth, no inflation, no meaningful wage increases. It was like the entire economy hit pause, and nobody could find the remote. So, the Bank of Japan did what central banks do when they run out of options. They cut interest rates to zero, then below zero. And when that still wasn't enough, they introduced something called yield curve control, which sounds complicated, but really just means we're going to keep long-term interest rates low no matter what. They basically glued interest rates to the floor. Now imagine you're a Japanese investor. You've got billions to invest, but your government bonds are paying you basically nothing. So you have two choices: accept zero returns or look somewhere else. They chose to look elsewhere, and that decision changed everything. Japan became one of the largest buyers of U.S. Treasuries, a major investor in mortgage-backed securities, and the world's largest creditor nation. In simple terms, Japan became the world's ATM. Here's how it worked. Meet Bob. Bob borrows money in Japan at near zero interest. He converts that money into U.S. dollars and invests in assets yielding 4%. After costs, he keeps the difference. That's called the yen carry trade. And when money is basically free, people don't just buy bonds. They buy stocks, real estate, emerging markets, anything that offers a return. For years, this became one of the biggest sources of global liquidity. At its peak, it was worth trillions of dollars. It was like global markets were running on Japanese Wi-Fi. But there was one critical assumption holding everything together: that Japanese interest rates would stay near zero forever. In 2024, that assumption broke. Japan raised interest rates for the first time in 17 years, and then they raised them again. And almost immediately, markets reacted. The S&P 500 dropped. Japan's Nikkei index plunged over 12% in a single day. That wasn't random. That was fear. Because when Japanese rates rise, borrowing in yen becomes more expensive, and hedging currency risk becomes more expensive too. Suddenly, the free money trade isn't free anymore. And when the math changes, everything changes. Because when the math flips, the capital flows flip too. For decades, money flowed out of Japan. Now, it's starting to come back. This is called repatriation. And it's one of the biggest hidden risks in global markets today. Because here's the uncomfortable truth. The cheapest source of global liquidity is no longer cheap. And this is where things get serious. Because Japan wasn't just any investor. They were one of the most consistent buyers of U.S. debt. And here's what most people get wrong. The Federal Reserve does not control long-term interest rates. The market does. So while everyone is obsessing over rate cuts, they're watching the wrong thing. Because long-term yields are driven by one thing: supply and demand. And right now, the United States is running trillion-dollar deficits every year. That means more debt needs to be issued, and someone has to buy it. For decades, Japan helped absorb that supply. But if Japan steps back, there's a problem. Because if demand drops, yields rise. And when yields rise, borrowing costs stay high, even if the Federal Reserve cuts rates. And that's how you get into a situation where the Fed is cutting rates, but financial conditions still feel tight. And this doesn't just affect bonds, it affects everything. Because long-term interest rates are used to value stocks. When rates stay high, the value of future earnings goes down. So even if companies are doing fine, stock prices can fall. Mortgage rates? Same story. They're tied to long-term treasury yields. So if those yields don't drop, mortgage rates don't drop either. That's why housing stays expensive. That's why refinancing slows. That's why transactions freeze. Corporate borrowing? Also affected. When money is cheap, companies expand, invest, and grow. When money is expensive, they pull back. So this stops being a bond market issue and becomes an everything issue. Because for 30 years, global markets were fueled by cheap Japanese money. And now, that system is unwinding. And when liquidity disappears, everything feels it. But here's the part nobody is talking about. Because it's not flashy, it's not trending, and it doesn't make headlines. People would rather talk about AI, or inflation, or whatever big tech stock moved last week. But the real forces that move markets, they're usually quiet, they're complex, and they're easy to ignore. And that's the danger. Because the biggest risks in markets aren't the loud ones. Those are already priced in. The real risks are the ones hiding in plain sight.
If you enjoyed this video, hit that like button and subscribe to receive more informative content.